We'll be going over IRS Form 4684, Casualties and Thefts. So there are 4 sections to this form. We'll go through each of them briefly. It's a 4-page tax form, so depending on your circumstances, you might not use every section in this form. So we're going to go through all of this step by step, but first there's section A, which refers to personal use property. For most taxpayers, this is probably what you're most familiar with if you've ever itemized tax deductions on Schedule A of your personal income tax return. We'll come back to this momentarily. On page 2, there's section B. This is for business income producing property, so business related casualties or theft. And there are 2 parts to section B. There's part 1 where you calculate the amount of casualty or theft, capital gain or loss for a property, and then part 2 where you summarize everything into either short-term or long-term capital gains and loss treatment. There's section C, which people will probably only complete if they've been the victim of a Ponzi scheme. So there are some rules in IRS Revenue Procedure 2009-20 that allow certain taxpayers to take a tax deduction on failed investments due to a Ponzi scheme. So we'll get into that a little bit more deeply. And then finally, section D is the election to deduct a federally declared disaster loss in a preceding tax year. So section 165I of the Internal Revenue Code allows taxpayers to elect, if they choose to amend the previous year's tax return in order to take the disaster loss in that previous tax year. So we'll get into that a little bit more in depth. And for most taxpayers, you're going to complete, not all 4 sections, but probably 1 or 2, maybe more, depending on your circumstances. So circling back to section A, the Tax Cuts and Jobs Act, which was passed in 2017, really put a lot of restrictions on being able to deduct casualty and theft losses for tax purposes on the individual income tax side. So basically, for tax years 2018 through the end of tax year 2025, taxpayers can only take a deduction for property that was lost in an event that's directly related to a federally declared disaster. So if that does not occur, then you're not able to deduct this casualty on your income tax return on the personal side. Even with that understanding, there still are some hurdles that most taxpayers would have to jump through in order to be able to really take advantage of this. So let's go through section A. First, we need to declare what type of losses you would be able to take this deduction on. So there are 3 different types of casualty losses that the IRS form instructions indicate. There's the federal casualty loss, and that is the loss of personal use property directly attributable to a federally declared disaster. That's what we're referring to when we're talking about section A. A disaster loss is a loss that's attributable to a federally declared disaster and that occurs in an area eligible for assistance pursuant to a presidential declaration. And then a qualified disaster loss Also includes an individual's casualty or theft loss of personal use property attributable to certain named events in the IRS form instructions. So if your disaster loss is one of these, then you would be able to declare that loss on your income tax return. So let's walk through this as if our taxpayer, John Smith, is declaring losses due to a federally declared disaster. So we'll put in his identifying number as his social security number. And then if you do not check this box here, then basically your loss is going to be disallowed. That's the FEMA declaration, and you can enter either the DR or the emergency number. And the example that is cited in the form instructions would be DR 4593. This refers to a federally declared event that happened in the Washington, D.C. area where they had winter storm damage. So now you'll enter in line 1 a description of the properties that were damaged. So you can see that there are up to 4 different rows, property A, B, C, and D, and they correspond to columns A, B, C, and D in lines 2 through 9. So we'll just assume that John Smith will put in type of property, a house, and we'll say that this was in and I don't know zip codes in DC, so we'll just put in a fake zip code, and then we'll put in the date that he bought this house. We'll call it 2020. Now, here in rows 2 through 9, we're going to enter certain information so that we can calculate whether or not there was a gain or a loss for this property. So let's imagine that he bought this property for $250,000 and his insurance covers, we'll just imagine that he had some sort of roof damage on his house and that his insurance company paid $5,000 for that. So if line 2 is more than line 3, we're going to skip line 4. Obviously, we can see that it is. So that means that we did not get a gain from this. We only have $5,000 of damage. So we're going to go down to calculating the damage to, or the impact to fair market value. So we'll just imagine that before the storm, the market value was $300,000. We'll also state that for intents and purposes, the fair market value was impacted by the cost of the roof repairs. And we'll just estimate that the cost of this roof repair is going to be $10,000. You can actually use a couple of safe harbor methods to be able to determine the impact to your fair market value. So one safe harbor method would be to use the amount of estimates that you would have needed to obtain a federal loan for safe harbor purposes, right? So if you had to get a FEMA loan to be able to make these repairs, then you could use the estimate that was used in that loan. And then the other way that you would be able to do this is if you actually make the repairs and you use a contractor's estimate that was actually used like if you actually make the repairs, then the cost of the repairs up to restoring your property's previous value, that is what you could use as the impact to your fair market value. So what you can't do is include the cost that you might incur if you improve the property's value beyond what it was before the casualty. So we're going to make the assumption that John Smith made these repairs to his roof. It cost him $10,000. That's reflected right here because he used a safe harbor method outlined in Revenue Procedure 2018-08. You can find the link to that in the IRS form instructions. So we now have the smaller of line 2 or line 7. Well, the cost basis is $250,000. The actual damage was $10,000, so that's the smaller. We're going to subtract the amount of insurance reimbursement, and now we've got our total casualty loss. Now, if we had multiple properties, we would be doing this in each column as they correspond to the row. Now, starting in line 10, we're going to consolidate all of the amounts on line 9 through each of these columns. And if you ended up with multiple forms, then you would have to consolidate all of these. So the 10,000 minus 5,000, or sorry, on line 9 we have $5,000, and that's the number we're going to carry over to line 10. Now you enter $100. However, there are certain instances where qualified disaster loss rules might apply. What you would do is then you would add the amounts on line 4 for all of our forms. So if we had any qualified disaster losses that we had a gain for, then we would compare this amount to the amount that's on line 10. As it turns out, if you're just reporting a disaster loss but not a qualified disaster loss, then you would enter $100 instead of $500. So we're going to say that this is attributable not to a qualified disaster. So the difference is you can deduct qualified disaster losses without itemizing other deductions on Schedule A. Also, your net casualty loss from qualified disasters does not need to exceed 10% of your adjusted gross income. That's the trade-off. So you're not subject to, you can take the qualified disaster loss deduction in conjunction with a standard deduction if you like. So that seems to be preferable in this tax situation. We do, it looks like we would qualify for a qualified disaster loss. We'll make the assumption that this was a major disaster that was declared by the president, and that's the real difference, is whether or not there was a presidential declaration. So we'll subtract that. We get $4,500, and now all of this information, if it hasn't already been consolidated into one form, needs to be. So you're going to add the amounts of line 4 across all of the form 4684s. We have 0 because we did not have a gain from the casualty. We're then going to consolidate all of the line 12 numbers. So that's 4,500. So now if line 13 is more than line 14, you would realize a capital gain. You would enter that difference here and on Schedule D, and then skip the rest of the section. If it was equal, if line 13 and 14 are equal, you would enter 0 and not complete the rest of the section. However, line 13 happens to be less than line 14. So what we do is we do have a disaster loss subject to the $500 reduction. However, if you did not, you would enter 0 and then go to line 16. We do have qualified disaster losses subject to the $500 reduction, so we're going to subtract line 13 from line 14. We're going to enter the smaller of this difference or the amount on line 12, which for us happens to be the same number. We would also enter this on Schedule A, line 16, for regular individual taxpayers, or for people completing Form 1040-NR, line 7. If you claim the standard deduction, then you would include this on line 16, the amount of your standard deduction on Schedule A. So do not complete the rest of this section if all of your casualty or theft losses are subject to the $500 reduction. So basically, we'll proceed through lines 16, 17, and 18 as if we're going to complete them, but for our example, we would stop here. So in line 16, if we were to continue, we would add lines 13 and 15 and then subtract the result from line 14. So that would end up being 0 here. Then we would enter 10% of our AGI. We would subtract that from the difference. So I'm going to put in some fake numbers here. We'll just assume that that's $5,000. And let's imagine that our adjusted gross income was $35,000 for the year. 10% of that would be $3,500. And then we would subtract this from that. And the $1,500 would be what you can claim on Schedule A as an itemized deduction subject to the AGI limitations. Okay. So that is the process for completing Section A on the personal side. Now let's switch over to Section B, where we're going to focus a little bit more on the business use side of property. So we're going to assume that John Smith is a sole proprietor, and we're going to use his business office, and we're going to say that his business office cost him $200,000, and miraculously he had roof damage. He had $5,000 reimbursement for insurance after the deductible. Now, again, we would kind of walk through a very similar process just as we did in Section A. In this case, there is no gain from the casualty or theft. His insurance proceeds are clearly much less than the cost of his property. So we would put 0 here. We're going to also assume that his fair market value was $300,000 before the casualty, is $290,000 now. So he had to fix his roof for $10,000. He got $5,000 as reimbursement. In line 26, we're going to enter the smaller of this loss versus the cost basis, right? So now we're comparing, the actual loss. We're going to subtract the insurance proceeds, and we get $5,000. So if we had multiple properties, we would be doing this across all of these columns. Again, property B would have to match with the column B, property C to column C, so on and so forth. So once we get line 27, figures across the board. We're going to calculate them, the total loss here. So now we're going to enter this total either on line 29 or on line 34. Okay, and the difference really is has to do with whether or not this property was held for 1 year or less, or if it was held for more than 1 year. And property that's held for 1 year or less is subject to short-term capital gains treatment or loss treatment, and has to reflect that. If there is a gain, we may end up reporting these figures on IRS Form 4797, which is basically the disposition of business use property. So we'll walk through each example, not that we would do both of them with the same property, but I'm going to walk you through each one just so that you can see. So we'll start with the 1 year or less. So when it comes to this, we're going to identify what the casualty or damage was. Again, this was attributable to the same storm damage. All right, so so we're going to enter the part from line 28 that's attributable to trade, business, rental, or royalty property in this column BI, or B1, sorry. And then in B2, it would be the same that applies to income producing property. So if John Smith had rental property, then it would be in column 2. Sorry, his rental property, business property, anything of that nature would be in column 1. Then in column 2, this would be for income producing property held for investment. This could include stocks, bonds, precious metals, works of art, things of that nature. So since we're talking only about the damage to his roof, we're going to focus here. So now, to be honest, if you have multiple properties, you could be completing both rows, right? So you might have John's roof with storm damage, and then you might have John's car, with some other damage, or maybe John lost some artwork because of the roof damage, and then that would be under column 2. Okay, so now that we've allocated this damage, 100% of it, to column 1, then we're going to walk across to column C. And again, this is in row 29. This is attributable to the casualty or theft of property that was held for 1 year or less, subject to short-term treatment. If we were doing this in line 34, this would be for more than 1 year. So in line 30, we're going to add everything together, which is easy because it's one number. Add this column and this column. Oh, sorry. Combine. Oops. Sorry, I made a mistake. We don't have any gains subject to, or that are includable in income in column C up here. So we shouldn't have put that in. However, when we summarize all the lines on line 29, we do get that number right here. There is no gain. So now we're going to add B1 and C. We get $5,000 here. This would be a net loss. So then this ends up going also on IRS Form 4797, line 14. However, if you're not required to complete that form, you would enter this on your Schedule 1 of your 1040, line 4, and then you would enter next to that line IRS Form 4684 to indicate that that line item is attributable to a casualty of business property. In column B2, you would enter any numbers here, and then you would also enter that either on line 16 of Schedule A or line 7 of Schedule A if you're filing 1040 NR. But you can't include a loss on property used as an employee. And for estates and trusts, you would enter this line item on the other deduction line of your tax return. So for partnerships, you would enter this on Form 1065, Schedule K, line 13D. For S corporations, you would enter this on Schedule K of your 1120S, line 12D. And in each case, you would enter Form 4684 next to the appropriate entry. So I'm going to back out of this, and then we're going to walk through this again as if this were a long-term event, capital loss. So the difference here is that you'll enter any existing casualty or theft gains from Form 4797, line 32. Well, let's just imagine we have $1,000 worth of gains here. And then our resultant property damage is $5,000 of a loss. We're going to add each column down here, so $5,000 loss goes down to line 35. You would then enter total gains from lines 33 and 34, column C. And we get $1,000 of gains. Now we're going to add the amounts on line 35, columns B1 and B2, and we get minus 5,000. Now, in line 38, if your line 37 is more than the gain on line 36, you combine column B1 and line 36 together, you enter the net loss here. That's pretty much exactly how this would go. For partnerships and S corporations, there's a note at the bottom of the form that shows you're going to enter the amount from one of these three lines on your respective Schedule K on your tax return. So, partnerships, Schedule K, line 11, S corporations, Schedule K, line 10. You're using different forms. So, this is scenario one where your loss is more than the gain. Now, if you had a gain here, or if you had any numbers here, you would enter that information on column B2. So for individuals, you would enter the amount from this property on line 16 of your Schedule A, or on line 7 if you're filing 1040 NR. Again, you're not including the loss on property that you used as an employee. Estates and trusts would enter this on the other deductions line of your tax return with a note, Form 4684. And then if your loss on line 37 happens to be equal to the gain on line 36, then you would combine those and you would enter the total here. And then you would follow, again, partnerships would enter the information on Schedule K. Everyone else would enter this amount on 4797. Sorry, if the loss is less than or equal to the gain. So if it's 0, then you would enter 0. But if you're actually realizing a gain out of all of this, then you would enter that on your 4797, line 3. So again, for business purposes, you're kind of netting this, and then as needed, you may be reporting on IRS Form 4797 as a disposition of business property. And then there are separate form instructions that walk you through, properly calculating your tax liability in that form. Section C refers to a theft loss deduction for a Ponzi type scheme. So Revenue Procedure 2009-20 came out on the advent of the Bernie Madoff Ponzi scheme scandal, and originally there was an Appendix A that outlined what how you calculate your deduction based on the theft loss related to a Ponzi scheme. Since then, the IRS has incorporated that Appendix A into Form 4684, and this is what you should use. You don't have to use Section C, but you can if you meet the following criteria. One, you qualify to use Revenue Procedure 2009-20 as modified in future Revenue Procedure 2011-58, and if you choose to follow the procedures and the guidance. So you would, if applicable, you would then complete Section C. Okay, so I'm going to actually go to Part 2 so you can kind of understand what you're declaring if you are doing this. So first, you have to declare that you're claiming your theft loss deduction in accordance with the procedure outlined in 2009-20 from a specified fraudulent arrangement. And then you have to basically put the person on notice. So, and the tax ID, unknown, and then address, you would actually put the actual address, but I just listed somewhere in New York. So you also have to state that a couple of other things. So you have written documentation to support everything that you're about to outline in the section above. Basically, how much your investment was, how much you recouped, if anything, and then how much you might have been insured for against a loss. Then you have to state that you're a qualified investor and that you have determined your amount of theft loss. If you used 95% of your theft loss because you don't see any third-party recovery being possible, then you're stating you're not going to go after it. So if, for example, there is some sort of reparations fund to make investors whole, you can't take the tax deduction related to your theft loss and then go back and try to recoup money. You can do one or the other, but not both. You're also agreeing to comply with the conditions and agreements in the revenue procedure and in Section C. And then if you've already filed a tax return that doesn't comply with the conditions, then you have to agree to any adjustments or actions in order to comply. And then you would have to list out the tax years for which you filled either a tax return or an amended tax return. So for example, you could say 2020 filed on 3/15/2021, and 2021's tax return, right? So you would do all of those things. So let's just imagine that you invested $100,000 with Mr. Madoff. You would put in your initial investment of $100,000. Now, this does not include any money that you might have borrowed from Bernie Madoff. It doesn't include fees that were paid and then deducted for tax purposes. It doesn't include anything that was reported to you as taxable income that wasn't included in gross income on the investor's side for tax purposes. So if it was reported to you as taxable income, but you didn't include it in your gross income, then don't enter that here. And then finally, you can't include any cash or property that you invested uh, in a fund or an entity that then invested in this fraud scheme. So if you were a mutual fund investor and that mutual fund turned around and invested in one of Bernie Madoff's investments, then you could not enter that investment here. You can only enter the money that you directly invested in the fraudulent scheme. Now in line 41, you would enter any amounts of cash that you subsequently invested after the initial investment. So let's just imagine that we put another $50,000 into it at some point. And then in line 42, we're going to include any income that was reported to you on previous tax years prior to the discovery year. So the discovery year is defined as one of the following: either the year where the indictment or the complaint that's described in Revenue Procedure 2009-20, the year that the indictment is filed, or the year in which the complaint is filed, or the death of the lead figure, whichever one is later. So if this has been a running scheme for 10 years, but the complaint isn't filed until year 11, then you have to include any income that was reported on your tax returns for those first 10 years. So let's imagine that you did receive some income over the period of time, $10,000. So that's $100,000 plus $50,000 plus $10,000 for $160,000. That represents your total investment. And this also includes any money that you reinvested, right? So so now we're going to back out any amounts of money that you took out. It doesn't matter if it was labeled as income, like dividends and interest income, or whether it was marked as a return of principal. Any money that you actually took out of this. So let's just say you took $60,000 out, and now your at risk or your total qualified investment was $100,000. So now we get to potential third-party recovery. The form instructions have a couple of definitions. First, the potential third-party recovery is the amount of all actual or potential claims for recovery as of the last day of the discovery year, not from insurance or SIPC recovery. So SIPC is the Securities Investor Protection Corporation, and it's not the potential direct recovery either. So potential insurance or SIPC recovery is the total of all actual or potential claims attributable to either insurance that you had against this type of loss, contracts other than insurance that guaranteed or protected it against this loss, or any amounts payable from the SIPC for customer claims under the Securities Investor Protection Act of 1970. And then finally, potential direct recovery is the amount of all actual or potential claims for recovery. So if you don't have any potential third-party recovery, you would enter 95%. If you have potential third-party recovery, as in, you might have a claim that you can, outstanding claim, then you can claim up to 75%. So we're going to assume that this money is gone. There's just no chance of recovering it. And so now we're looking at $95,000 is, the top end of, what we could possibly deduct. So line 48 would be the amount of money that you actually received And again, you wouldn't include anything that's a potential direct recovery or a potential third-party recovery. This is money that actually got reimbursed back to you. So we'll just say that you did get $45,000 of your money back, and then on line 49, you would enter the amount of possible insurance or SIPC recovery. Let's imagine that you might be able to get $10,000. So your total recovery is $55,000, which means your deductible theft loss would be $40,000. You would include this amount on line 28 of section B, but you would not go back through lines 19 through 27. So let's go back up to 9. So right here, your casualty or theft loss would be includable here. So if we had to take this $40,000, we would combine it with the $5,000 here that came with this, and then we would go through, you know, the same part 2 as if the $40,000 had been up here and we went through that. Okay, so the section C loss goes back to feeding section B, and then you would complete part B. But you don't need to complete lines 19 through 27. That is what section C was to do this. Okay, and then we already completed part 2 with the information that we would be attesting to, and this is to help the IRS really kind of piece this together. So, and then finally in section D, we're going to pretend that our hero, Mr. John Smith, is looking to elect to deduct the federally declared disaster loss in a preceding tax year. So you would be eligible to do this under Section 165 if it was a federally declared disaster and if it occurred in the disaster area in the tax year immediately preceding the loss. So if your tax loss was in 2022, then you can roll that back and take a deduction on your 2021 tax return. You would most likely need to amend that tax return because it's already been filed, most likely. So let's just say that this storm happened in December of 2022, and then you would say, you know, the address. So this is the location where your damaged property was located. So that's what you would do. You would attach Section D to your tax return or your amended tax return, depending on how you're going. Now, if you want to revoke that prior election, you can do that too. So your option to make the election, you have to make it within 6 months after the regular due date for filing your original return. So if you made this election, you know, for a loss that occurred in the 2022 tax year, you can make this all the way up until 6 months after the 2022 tax filing deadline. So this year, the 2022 tax deadline was April 18th. Then you could put 6 months after that. You would be able to make this election all the way up until October 18th of 2023 to be able to then go back and amend your 2021 tax return should you think that that is preferable. But if you decide to revoke that, then instead of completing part 1, you will complete part 2. and then you would say, all right, the name of the disaster, Washington, D.C. winter. You would specify the date that you filed the prior election that you're now revoking. So you wouldn't put the date of the event, you would put the date of the prior election. So let's just imagine that you filed your tax return you filed your 2022 tax return, and that was also when you decided that you were going to amend your previous tax return. Because you revoked this, you now have to either recalculate and submit your payment, or you should explain, how this credit is going to be repaid. So you might revoke your prior election based on the fact that your current tax year is actually more profitable than you thought, and you're better off taking the election in the current tax year where you incurred the casualty instead of the previous tax year, right? The benefit of being able to roll that back to a previous tax year or the immediate previous tax year is that there's a working assumption in a lot of cases with casualties where your income for the year will be lower. For example, after a hurricane, if a hurricane hit you in July and shut down your business for the rest of the tax year, then your taxable income would most likely be much lower. So then you would choose to roll that casualty loss to the previous tax year where you would get more of a tax benefit. You revoke that in the case that you decided at the end of that tax year where you incurred the loss, your business wasn't really that impacted, and you'd rather take that in the current year. So an argument would be, well, I got a $5,000 tax refund when I amended it, but if I put that in this year's tax return, that's a difference of $6,000 because of the difference in my marginal tax bracket, right? The impact to my taxable income. And then you can say, well, when I file this new return, I'm going to owe back here for the 2021 tax return, but I'm going to be able to make it up in the 2022 tax return when I refile that. Or you could just calculate that and submit the payment, right? So right. So you might want to consult with your CPA on how to word line 57, but this basically kind of expresses when you amend your new return and you expect to get a tax refund, you then also have an option to make extra payments out of that return. So you can say that that's what you would like to do. It might be easier for you to just submit a payment with your amended prior year tax return, clean that bill up, and then receive the tax refund when you amend your other return. It might be easier, but you do have the option to do either or. So those are 4 sections of IRS Form 4684. Most taxpayers are not going to use all 4 sections. However, that is a possibility. That's all we have for this tax form. If you want to go deeper into this, we've written a complete article that you can check out on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 4684 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or concerns, please post them in the comment section or send me an email. Thank you very much and have a great day.